Hello and welcome back to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to formulate a view on where the market could be heading over the near term. We have a week packed with events, with economic data, with earnings releases, and to start off, we've got the partial federal government shutdown. It is now the second longest in history, but it does not matter. The inflation and economic growth data are driving the S&P 500 to fresh record highs. So look, here's the thing. Various government agencies during the government shutdown have stopped releasing economic reports, but the CPI, the Consumer Price Index, is a legally mandated report that's needed to make and determine cost of living adjustments for Social Security. So a special accommodation was made to get the CPI report out. The CPI for the month of September, it showed a headline increase of 3%, while the core figure that strips out food and energy prices, it also gained by 3% compared to last year. And that's what this chart on here shows. This black line on here shows the 12-month rate of change in the core CPI. You can see overall we've had this disinflation trend off the 2022 peak, except for over the past year or so, you've had core CPI stalling out, this black line stalling out around the 3% level. It's been chopping around that level. But the thing you want to pay attention to is some of the more recent annualized changes. So the 3-month change, this light blue line, the darker blue line is a 6-month annualized change. You can see both of those ticking up here in recent months. So that's something to keep an eye on with CPI, specifically with core CPI, is if we see this inflection higher and more recent annualized gains, more recent annualized movements in CPI, if that starts to flow through to the 12-month rate of change in the core figure itself. But here's the thing though. While the core headline figure accelerated to the headline figure accelerated to the highest level since January, the increase in CPI, both the headline and the core figure, was less than expected. And so that is boosting hopes for rate cuts by the Federal Reserve. Now look, market implied odds are already locked into a quarter-point cut at the Fed's last two meetings this year. We have a Fed meeting later this week, but right now the market is priced. This is CME market implied odds. Market implied odds are pointing to 5 quarter-point rate cuts over the coming year. So you can see the range of Fed funds that's being targeted across the top, and the each Fed meeting date here as well. And you can start to look at kind of the probabilities, the central tendencies of where the market expects rates to be, which range it's going to fall in. And you can see, there's essentially a 96% chance that rates will be cut to a range of 3 3/4 to 4% at the Fed's next meeting. You can see another big, you got to look at these two together. So, close to a 97% chance when you add these together that the Fed funds rate is going to be dropped another quarter point from that level. And so you start to extrapolate this out to the future, and you can see over the next year, to September, October 2026, the market is pricing about 5 quarter-point rate cuts over the coming year. Now, here's the thing. Global efforts to reduce rates, they are already underway. Through last month, there have been 312 rate cuts on a 2-year cumulative basis when you look at central banks around the world. And here's why that's significant. It's because that is the most since the aftermath of 2008's financial crisis. So the Fed's cut. So we already have a coordinated global easing campaign underway. The Fed is rejoining that effort. At the same time, S&P Global, they released an initial look at manufacturing and service sector activity for the month of October. And look, that report is taking on increased importance because government data, we're not receiving government data during the shutdown. So we can look at these private sector alternative sources of data, and they showed activity jumping to its best level in 3 months. So here's the thing. The evidence of economic growth, that's boosting the earnings outlook. We already have loose financial conditions, and now we have this prospect of the Fed cutting interest rates into a strong economy in already loose conditions, and that is just more fuel for the stock market rally. So here's what we want to look at this week. This week we are going to unpack the global monetary easing cycle that's already underway. And look, economy is doing just fine right now. This easing cycle underway is rivaling rate cuts that we tend to see during times of crisis. And we'll also look at some alternative data for clues on the health of the economy and why conditions are aligned to send the stock market rally into overdrive in the months ahead. That comes down to breadth and sentiment. We'll talk about that in just a second. But first, let's talk about rate cuts. So here's the thing. Progress on consumer inflation stalled out over a year ago. Core CPI has been hovering around 3% since July of 2024. That is well above the Fed's 2% inflation target, but concerns over the health of the labor market, that's what's locking in expectations for more rate cuts looking ahead, especially here in the US. So the Fed, they did recently restart the cutting cycle. They did a 0.25% rate cut at the September meeting. But look, the global easing cycle is already underway, and that's what this chart is showing on here. The chart shows the cumulative central bank rate cuts on a global basis over the past 2 years. You can see the number of total cuts is approaching the levels that were seen in the aftermath of the 2008 financial crisis. So again, 313 cuts. This was coming out of the financial crisis in 2008. I mean, downright economic depression, worst economy since the Depression, and we're nowhere near that in terms of what's happening, what has happened with the economy, but we're getting all these cuts anyway. This is just a massive tailwind for the rally that you've seen in risk assets. Now, concerns over the health of the economy are intensifying as a partial government shutdown becomes the longest in history, or second longest in history. So, here's the thing with the government shutdown. There's the immediate impact of less government spending and furloughed federal workers. That's being estimated right now to cost the economy about $7 billion every week. But the other thing with the shutdown is that government agencies are not releasing key economic reports, and that's leaving investors in the dark about the state of the economy. But we have private sector data, private sector companies that are still releasing their own data. And so that's why you want to focus on this report from S&P Global, which is showing U.S. economic growth is actually accelerating. Their composite PMI figure, it covers the services and manufacturing sector of the economy. It increased to 54.8 in October. That's the blue line on this chart, tracks that PMI. An increase of 54.8 in October. That is a 3-month high. You can see that's at the high end of this range going back several years. Now, reading above 50 indicates expanding activity, and you can see these darker gray bars on here. That is gross domestic product, the annualized change in GDP year over year. You can see it tends to correlate well with the rate of change in this blue line tracking the PMI. So again, we're seeing a tick higher in the PMI. It's the highest in 3 months at the high end of the recent range. That bodes well for economic activity. All right, so fears are growing over a stock market bubble, and one reason is because concentration in the stock market's major indexes is hitting record highs. The top 10 stocks in the S&P 500 now make up nearly 41% of the index. That is a record level in such few stocks. But while the market's top names continue rallying, that is masking strength that you're seeing in the average stock. So what we can do is we can track the number of advancing stocks versus declining stocks across the market. That's a way to gauge what the average stock is doing. And one of those ways is by looking at the NYSE's cumulative advanced decline line. That's what this line shows on here. The NYSE AD line just takes the number of advancing stocks versus declining stocks on any given day, and nets those out and adds them to the previous day's total, and that's how you get this line. So what does this line represent then? Well, it's just a way of tracking what the average stock is doing. And the thing you want to look at, paying attention to, is that the average stock is making a new all-time high last week. And so despite everything you hear about the Mag 7, despite everything you hear about concentration in the indexes, yes, it's true, but the average stock is performing just fine here as well. Now, there's a popular saying that the stock market will climb a wall of worry, and this rally that we've seen off the early April lows has been the perfect example. Investor sentiment has been so quick to shift back into fear territory on just any rumblings that we have in the stock market. And now you've got the S&P 500 at record highs. Despite that, CNN's Fear and Greed Index is showing fear as a prevailing emotion. You've got the AAII survey of retail investors that has bearish views at 42.7%. That's well above the historical average, and that outnumbers bullish views on the stock market. Now, those are some sentiment indicators. We want to also pay attention to positioning and indicators of actual positioning, how investors are voting with their own dollars. That is nowhere near extremes. This indicator on here, this is an indicator of equity positioning from Deutsche Bank, and it shows equity exposure overall is at neutral levels. Okay, so that's what the zero line represents. This scale on here is a Z-score for this indicator. When this gets stretched up way above zero, that indicates a higher than average equity positioning. Below is a lower than average equity positioning. And right now you can see the line's right back here at zero, but there's a big weekly drop. This was the largest weekly drop since the sell-off into early April. So again, we're seeing there's just no signs of froth out there, and whether it's positioning data or survey-based indicators, you're so quick to see investor views and positioning shift back into fear territory or cuts to equity exposure, and that's a contrarian thing. This is a good thing here for the rally. Now, just as investor sentiment shifts back to bearishness, equity exposure is being reduced. We talked about breadth metrics signaling strong participation, but here's the thing. The S&P 500 is starting its best short-term seasonal stretch when you look at historical trends. So the sell in May and go away, that's a 6-month period that concludes with the start of November. So we're now entering a favorable 6-month stretch, but on a shorter-term basis, when you look at 3-month forward returns, last week marks the start of the best 3-month period for the S&P 500 when you look at data going back to 1928. And so that's what this red line on here tracks. This is tracking, from this point in time, what the 3-month forward return in the S&P 500 looks like. And you can see we're near the highest levels on the year. So we've been approaching this level here over this past week or so. And so we're in this sweet spot for seasonality at a time when we're seeing evidence that the economy is growing. There's bearish investor sentiment, which is a contrarian indicator, and we're seeing strong breadth as well. So all these things just coming together at the same time, you have that you're entering a very strong seasonal stretch for the S&P 500. All right, super busy week ahead. We've got a lot of things this week. We've still got government shutdown headlines out there. We have potential the framework for a trade deal between the U.S. and China. We have a Fed rate setting meeting while we still are in the thick of earnings season. In fact, this week is going to be the busiest week for earnings season for the S&P 500. There were 175 names in the S&P 500 that are reporting earnings, including many heavyweights, several of the Mag 7 stocks. So we've got Meta, we got Microsoft, we got Google parent Alphabet, we'll have Amazon, we'll have Apple, and just among some of the other names shown on this chart that are reporting earnings in the week ahead. And so, keep a close eye on how, especially how the outlook is evolving with these companies. So I believe investors will be less concerned about what's already happened and more concerned about what guidance heading into next year looks like, and if we can continue to see forward earnings estimates collectively for the S&P 500 hitting new highs as it has been recently. All right, one trade idea to keep an eye on this week is with Brazilian fintech name New Holdings, so ticker NU. And here's why I want to have this stock on the watch list. If you pull up an income statement and projections, you'll see that this stock has a very strong year-over-year quarterly rate of change in both sales and earnings. So that's one reason why we want to have this growth stock on our radar in the first place. But now we're getting to an interesting point with the stock, because you've had a series of higher lows since this pullback after the stock peaked around $16 in late 2024, early 2025. You had the initial drawdown that tested the lows around $10 into the early April sell-off across the market. And now you've had on these rallies just these smaller pullbacks along the way. Well, recently we're back near that $16 resistance level. MACD was extended, momentum was extended. We had a really nice run from 12 to 16. Now we're getting a smaller pullback that's retraced less than half this prior move. That's resetting the MACD at the zero line, and now look at where price is once again, right back to that $16 level. So that is a key level to watch on ticker NU in the week ahead, and if we can get a breakout above that level. One other area of the market to watch this week is with oil prices. Oil prices making headlines last week with the Trump administration announcing new sanctions on Russian oil. Some questions around if India and China in particular will continue to buy Russian oil. That could be remove a significant source of supply from the market, yet those countries are still have to meet demand. And so you're seeing a rebound in oil prices off of a key level. So oil would come down to right below $60 per share, so around $56, $57 per barrel back in May. Recently retesting that level, so we have a double bottom in place. At the same time, MACD showing downside momentum getting a little extended, so you can expect a rally or rebound off that level. And so this is something to keep a close eye on. Oil's been in this general bearish pattern for several years now, and we'll see if we can get some upside follow through off this double bottom, because here's why this is important. We've been also following broad commodity indexes. Well, guess what? Oil and oil derivatives like gasoline are a huge component of these broad commodity indexes, and they have been basing for several years now. So a rebound in oil prices could finally drive a breakout in these broader commodity baskets. I think that could be a huge trade setting up for the year ahead, and one that will eventually come back to bite stock market investors, because a rebound in commodities would stoke inflation, and that would, with core inflation already running at 3%, that would present more upside pressures to inflation and could cause the Federal Reserve to have to pivot away from rate cuts that are now on the table. All right, that is all for this week. Good luck trading in the week ahead.